case we have never met, I'm Michael Price, and I want to help you succeed in growing your business.
Happy Friday, everyone. It is February 27th, 2026, and today we are going to talk about the single most powerful piece of plastic in the United States.
Right. And it's definitely not the black card you see in the movies. It is significantly less glamorous.
Much less.
But for a business, it is arguably much more valuable.
We are talking about the government purchase card.
Mm-hmm.
And, to the untrained eye, it just looks like a standard Visa or MasterCard.
Yeah.
But to a vendor, looking at the stack of sources we have for this deep dive, it looks like the ultimate loophole.
It really does.
Because it's a mechanism that lets a federal employee just bypass months of bureaucracy. They skip the bidding wars and they just swipe. Instant payment.
It is the closest thing to free money you will find in the federal sector. But as we dug into the latest federal acquisition regulation updates and some pretty alarming audit reports from the Treasury, it became really clear that this free money has a very sharp hook hidden inside it.
Exactly, and that is the mission for today's deep dive. We aren't just looking at how to get the card swiped.
Right.
We are going to trace the entire life cycle of a vendor who gets addicted to that easy swipe. Because it starts out great. It's an awesome way to bypass red tape.
Oh, absolutely.
But if you look at the regulations specifically, the Competition and Contracting Act, relying on that card too much is actually a federal crime waiting to happen.
It's a classic honeypot.
Yeah.
The system just draws you in with all this efficiency, but if you stay there too long or you try to stretch the limits, you run headfirst into an internal auditor.
And that is not a collision you want to have.
No, definitely not.
So let's set the stage here. The big news driving this conversation happened late last year. As of October 1st, 2025, the government gave this entire program a massive raise.
They did. This was the inflation adjustment we'd all been waiting for. We are talking about the micro-purchase threshold, or the MPT, which is the statutory limit under which a government employee can buy something without having to solicit competitive quotes.
And for a long time, that limit was just sitting at $10,000.
Exactly. But under 41 U.S.C. 1908, the government has to review these thresholds for inflation every 5 years. And given the economic climate of the early 2020s, the adjustment was significant. So as of October 2025, the standard MPT jumped to $15,000.
A 50% increase in purchasing power, just like that.
Huge jump.
Now, 15 grand might not sound like a lot for a government that buys aircraft carriers, but for you as a small business, that is huge.
Oh, yeah.
That's a lot of laptops. It's a lot of tactical gear.
It is a massive amount of volume. And the appeal for the seller isn't just the dollar amount. It's the speed.
Right, the lack of friction.
Exactly. When a purchase is under that MPT, the buyer doesn't have to write a solicitation. They don't have to post it publicly. They don't even have to verify if your price is the absolute best price. They only have to decide that it's reasonable.
And here's the kicker I found in the sources. You don't even need to be registered in SAM.gov, right?
Generally speaking, that is correct.
Which is crazy.
If the agency uses the card as both the purchasing method and the payment method, and it is under the threshold, you can effectively operate as a ghost.
A ghost in the federal system.
Yeah. You don't need a cage code. You don't need to be in the massive federal database. You just hand them the invoice, they swipe, and the money is in your bank account within 24 hours.
So naturally, vendors are buzzing about this.
Yeah.
We pulled some threads from the defense contracting communities on Reddit, and the advice is just rampant.
Oh, I've seen it.
People are saying, forget the complex bidding systems. Just build relationships with the end users. Because if you can keep the sale under $15,000, that end user doesn't even have to ask their boss for permission.
It sounds like the perfect business model, but we need to apply a crucial filter here because I saw some of that exact same advice, and a lot of people are getting it very wrong.
How so?
Because this $15,000 limit is not universal.
Okay. This is the supplies versus services trap. I really want to unpack this because it feels like a massive gotcha rule.
It absolutely trips people up. The inflation adjustment to $15,000 applies to supplies, standard commercial items.
Okay.
But if you are providing services, that limit is governed by the Service Contract Labor Standards, and it is capped at $2,500.
$2,500? Wow, and what about construction?
Even lower, $2,000.
Geez.
That's tied to the wage rate requirement statute, which most people know as the Davis-Bacon Act. Those laws did not get the inflation bump.
So let's play out a scenario just to make this concrete for everyone listening. Let's say I'm a vendor selling high-end drones, commercial, off the shelf, and they cost $13,000 each.
You're golden. That is a supply. The buyer can swipe the card for $14,000, no questions asked.
Okay, great. But let's say the agency crashes the drone a week later. They call me up and say, hey, we need you to come out and fix this. The repair bill is $3,000
Now you have a problem.
because it's a service.
Exactly. Repair is a service. The limit for services is $2,500. So even though $3,000 is way less than the $15,000 limit you are used to, a cardholder cannot legally swipe their card for that repair job.
It seems so illogical that I can buy the drone for $14,000, but I can't pay $3,000 to fix it on the exact same card.
It's not about logic, it is about labor laws. But vendors miss this all the time. They think, well, the limit is 15 grand and they run the charge.
Yeah,
That is an unauthorized commitment. But honestly, that is a minor infraction compared to the real trap we found in the sources.
let's talk about the real trap.
Hmm.
Because this is where the story shifts from a simple administrative error to outright illegal activity.
Right. So let's stick with your drone company example. You are selling supplies, you are fully compliant.
Okay,
You are moving $14,000 orders every single month. Life is good, but success creates its own problems.
always does.
The agency loves the product. They call you up and say, we don't want just one unit anymore. We need to outfit the whole division. We need $60,000 worth of gear.
And as a business owner, I am seeing dollar signs. I want that deal.
Of course you do, but the buyer has a problem. Their credit card limit is $15,000. The order is $60,000.
And this is exactly where the helpful buyer says, hey, no problem, I really want to get you guys paid fast. Why don't I just run your card 4 times?
Yep.
$15,000 today, $15,000 tomorrow, and so on.
And if you say yes to that, you have just conspired to violate federal law.
That feels heavy. I mean, from a civilian perspective, it's just processing payment in chunks, isn't it? Why is that a crime?
Because it's what the government calls a split purchase, and it is not just about the credit card limits. It's about circumventing the Competition and Contracting Act, or CICA.
Let's break that down. CICA is the law that basically says the government must hold a competition for taxpayer money.
Exactly. The micro-purchase threshold is a very specific exception to CICA. Congress essentially said, okay, for the really small stuff, we will waive the competition requirement because it costs way too much administratively to run a full bid.
Right, the red tape costs more than the item.
Exactly. But the moment you have a $60,000 requirement, CICA applies. You are legally supposed to bid that out so other companies in the market have a chance to win it.
So by breaking it into 4 small chunks, you aren't just making payment easier, you are effectively hiding the purchase from the open market.
Precisely.
You are stealing the opportunity from your competitors.
You are using a loophole to evade the law, and the internal auditors are specifically hunting for this.
Yeah, let's talk about the auditors.
We have a report right here from TGTA, the Treasury Inspector General for Tax Administration, dated January 28, 2026, just last month.
This was the audit of the IRS purchase card program.
Yes, and the IRS is a massive agency. They have thousands of cardholders spending millions of dollars. So TGTA went in to look for compliance.
What did they find?
Out of their sample group, they found 6 confirmed violations, and 5 of them were split purchases.
Wow, so it really is the most common crime in this space.
It is, and the thing is, auditors don't need to sit there looking through paper receipts anymore.
Right, they have software for that.
They use data mining. They look for clusters, same vendor, same in 3 to 5 days of each other.
Oh, wow.
If the total exceeds the threshold, the system just flags it automatically. You can't hide it.
So let's talk about the consequences of getting flagged. The TGTA report mentioned that the IRS employees involved got counseling.
Yeah.
Which, I mean, that sounds like a slap on the wrist, but what actually happens to the vendor?
The vendor gets the door slammed in their face.
Really?
This is the pivotal moment in our vendor's life cycle. The internal auditor flags the transactions. Then they contact the contracting officer, who is the person with the actual legal authority, and they say, this vendor is abusing the purchase cards.
And the contracting officer issues a stop work order.
Essentially, yes. They tell the buyer, you are forbidden from using the purchase card with this vendor ever again. The faucet just turns off instantly.
So you went from easy money to zero revenue overnight.
And usually, the buyer who actually really likes your product comes back to you in a total panic.
Yeah, they still need the drones.
Exactly. They say, look, I can't swipe the card anymore. The auditor is breathing down my neck, but we still need the gear. You have to get a contract.
The graduation. This is the ultimatum. If you want to keep selling to the government, you have to do it the hard way now.
Correct. You are being pushed up into the next tier of procurement. You are now officially in the zone of the Simplified Acquisition Threshold, or the SAT.
Which, by the way, also got an inflation adjustment in late 2025.
It did. The SAT went from $250,000 to $350,000.
Okay.
So we are talking about any purchases falling between the $15,000 card limit and this new $350,000 ceiling.
and the rules in this zone are completely different.
Night and day. In this zone, the government must seek competition. CSA is fully back in play. They generally need to get 3 quotes. They have to set the work aside for small businesses. They cannot just pick you because they like you.
So, if I'm the drone vendor and I want to save that $60,000 deal, I now have to write a formal proposal. I have to actually compete against 2 other companies.
Typically, yes. Unless you have what we like to call the easy button.
The GSA schedule.
The GSA schedule. The internal auditor will almost always suggest this to the buyer. They will tell them, if this vendor gets on a GSA schedule, we can keep buying from them easily.
But how does the GSA schedule actually solve the competition problem? I mean, if CSA requires 3 quotes, does having a GSA contract just waive that requirement?
Not exactly. It streamlines it. We looked up a win-veil analysis on this in our sources.
Yeah, that was a fascinating breakdown.
Right. Under FAR subpart 8.4, if a buyer logs into GSA Advantage, which is basically Amazon for the federal government, and they click on your product, and then they view the prices of 2 other similar products, that counts.
Wait, that counts as competition? Just looking at the screen.
It's often called the 3 clicks rule. They compare your price to 2 others, they document it, and they click buy. They don't have to post a public bid, they don't have to wait 30 days. It satisfies the auditor because the GSA contract prices have already been predetermined by the government to be fair and reasonable.
So for the vendor who got caught in the split purchase trap,
Mm-hmm.
the GSA schedule is basically the escape hatch. It legitimizes the relationship. You can take that $60,000 order completely legally.
It saves the business relationship. But, and here is the massive twist we uncovered,
There's always a twist.
solving this one problem creates a much, much bigger one. To get that GSA contract, or really any contract, over the micro-purchase threshold, you have to cross the barrier. You finally have to register in SAM.gov.
Which brings us to the barrier. I feel like everyone in this space complains about SAM.gov because the website itself is pretty clunky.
Oh, definitely.
But we aren't talking about user interface issues here. We are talking about data disclosure.
We are talking about the genealogy test, FAR subpart 4.1.
Yes. Look, in the last few years, the government has become absolutely obsessed, rightfully so, honestly, with supply chain risk management. They don't just want to know your company's name and address anymore. They want to know exactly who owns you.
The form explicitly asks for the immediate owner and the highest level owner.
Right? The immediate owner is who signs your checks. The highest level owner is the absolute top of the food chain. Now, for a simple LLC where you are the sole owner, this is super easy. You check self and you are done.
But let's go back to our drone company. To build those high-tech drones, maybe I needed serious capital. Maybe I took money from investors. Maybe I'm owned by a private equity firm. Or maybe it's a family business, technically owned by a trust. And that is exactly where you hit a brick wall. The regulations require that if you are owned by another entity, you must disclose that entity's legal name, their physical address, and this is the truly critical part, their cage code.
Wait, the private equity firm itself needs a cage code?
Yes, which means the private equity firm has to register in SAM.gov too.
I can just imagine how that conversation goes. You call up the partners at a massive PE firm in New York and say, hey, I need you to hand over your corporate details to the Defense Logistics Agency so I can sell 60 grand worth of drones.
They will laugh you out of the room.
Oh, yeah.
Private equity firms, generally speaking, value privacy above almost anything else.
Totally.
They do not want to be in a federal database. They do not want their ownership structures mapped out by government auditors.
Because trusts are even worse, right?
Oh, much worse. If your business is owned by the Smith Family Trust, the Defense Logistics Agency views that trust as a legal entity. They will often demand to see the actual trust agreement to validate the legal name and the control structure.
They want to read the private trust papers. That feels incredibly invasive.
It feels invasive to the family, sure, but to the government, it is strictly about national security. They are terrified of shell companies. They need to know if that quote-unquote American small business is actually owned by a massive conglomerate with ties to foreign adversaries. They need to see the bottom of the turtle stack.
So you're just stuck. You can't use the credit card because the orders are too big and the auditors stop you.
Yep.
And you can't get a GSA contract because your investors absolutely refuse to register in SAM.
This is what we call the valley of death for scaling government contractors. You are too big to fly under the radar, but your corporate structure is too complex to be transparent.
And this brings us to the stakes. Let's say our vendor gets desperate. They really need that GSA contract.
Yeah.
So the CEO goes into SAM.gov and just fudges it.
Oh boy.
They check the box that says no immediate owner. They pretend the PE firm doesn't exist just to get the registration active and keep the revenue flowing.
Well, now you have moved from a simple administrative headache to a massive federal crime.
The False Claims Act.
The FCA. The government takes the firm position that knowing who they are doing business with is material to their decision to pay you.
Material meaning it dictates if they issue the check or not.
Exactly. If you lie about your ownership, especially if you are hiding a private equity firm that might have foreign limited partner investors, you are effectively submitting a false claim every single time you send an invoice.
And the penalties for that are incredibly severe.
Triple damages plus per invoice penalties. It can bankrupt a company overnight.
Wow.
And here's a detail from the sources that catches even the most sophisticated companies completely off guard. It's not just about the ownership percentage. It is about control.
Explain that distinction, because I think a lot of people miss that.
Let's say the private equity firm only owns 40% of your company. They aren't the majority owner. You might think, I don't need to report them.
Right. I'm still majority owner.
But usually, that PE firm has the right to appoint members to your board of directors.
Sure, they want oversight on their investment.
If those board members have interlocking management duties, meaning they also sit on the board of the PE firm or other portfolio companies, that can actually trigger a change in control definition in the eyes of the government.
And if control changes?
You have 30 days to update SAM.gov.
30 days. That is no time at all in the corporate world.
If you don't update it, your registration is inaccurate, your representations and certifications are legally false, and you are actively invoicing the government under false pretenses.
It is quite literally a ticking time bomb.
Yeah.
You could be operating for years thinking you were fully compliant, and then a whistleblower or a random auditor connects the dots between your board of directors and that PE firm you didn't disclose.
And suddenly, that easy money we talked about at the very beginning, it creates a legacy of liability that can wipe out years of profit.
It really completely changes how you look at that $15,000 credit card limit.
It does.
It feels like an invitation, but it's really just the top of a very slippery funnel.
It really is. The takeaway here isn't don't sell to the government, it's know your lane. If you are a micro-purchase vendor, stay small. Enjoy the $15,000 swipes. But if you plan to scale, if you plan to take that GSA contract the auditor is forcing on you, you need to have a very difficult conversation with your investors before you sign the papers.
You need to ask them point blank, are you ready to be in the federal database?
Exactly. Transparency is the price of admission for the big leagues. You cannot have the revenue of a prime contractor with the secrecy of a private holding company. The systems just do not allow it anymore.
I want to leave everyone with a thought to mull over this weekend. We focus so much on the external threats to a business, right? Competition, market shifts, the economy.
Yeah.
But in federal contracting, the biggest threat might actually be the data you entered into a basic web form 3 years ago and just forgot about.
Or the data you intentionally didn't enter.
Right? If the government decided to audit your SAM.gov ownership profile today and they compared it to your actual cap table or your private board minutes, would they find a match? Or would they find a false claim?
It is definitely a question worth asking before you send that next invoice.
Absolutely. Well, that is it for this week's deep dive into the absolute weeds of federal procurement. Thanks for helping us navigate the maze.
My pleasure. Just don't split those purchases.
We wouldn't dare. Thanks for listening, everyone. We will catch you on the next one.
A special thank you to MarketUS.com for furnishing us this information. You can reach them at MarketUS.com or call them at 954-636-3232. Before we go, this deep dive was created by the MarketUS.com team. Let us know your thoughts in the comments below. It's right below the subscribe link.